actually. This is the first session, right?
That's my first masterclass.
Got it.
Yeah, the first of 8 weeks, 2 a week, and then we've got lunchtime sessions planned as deep dives into specific topics.
Great. It's quite full on, isn't it?
Yeah, I think our
content.
group, yeah, absolutely. We're trying to give as much as possible, and I see our interns are all flying in. 21 already. Wow, faster than yesterday. Michael, you're in demand.
Great. Keen beavers, huh? All very keen. Yeah. I'm not sure what proportion of the cohort is in the UK, but flipping out. I mean, with this kind of weather, I feel like I should be sat in a garden somewhere.
Yeah. And I think we have today and tomorrow, and then it's rain till June. So
yeah.
Partly I was thinking to book tomorrow off, at least I'm tomorrow off to go out and try and get some of that vitamin D before it goes away.
Nice. Yeah, very strange to have 30 degrees in September.
Yeah.
But there you go.
We probably have some people in South of Europe joining today's session who are probably laughing at your comments there, Michael.
Yeah. The thing is, I love the heat. It's only when you're working indoors a lot and you start sweating and things get a bit more challenging.
Yeah, absolutely.
I'm just gonna put my phone on silent actually.
Yeah, no worries. No problem. Hello everyone. I hope everyone has had a fantastic second day of the Future VC program. Do share your questions, comments, do put things in chat. We'll give everyone just one more minute and then we can get started. First question in, Michael. Someone's trying to figure out if your background is real or not.
You know what? I get that question all the time. I wish it was real. It's my vision board in some ways, right? At some point, I'll be able to buy a house somewhere in a place like it. But no, it's just the lighting. The lighting just happens to be at a good time during the day. Otherwise, you start seeing all sorts of weird artifacts. Things start to change.
Thanks for the question, Oscar. Right, we are at 38. Let's get going. So, Michael, you returned to deliver a session on the introduction of VC. You've did this a couple of times before. I think this is your third time.
Yeah, fourth time actually. Because I did it with another group outside of the diversity VC cohort as well.
Amazing.
So there you go.
We always get fantastic feedback. So super excited. Just a bit of housekeeping before we get going. I said this yesterday as well. Welcome everyone to the Future VC program. If you've not got access to Slack yet, do reach out to me afterwards. I'll put my email address in the chat box in a moment. And if you are not already on Notion, please do join. That's where you'll find kind of details and updates and the timetables for the rest of the program. That said, I'm going to hand it over to Michael. Michael, perhaps if you can kick off with a short intro and then do take over for today's session for everyone. Do add questions in the Q&A section of Zoom, or you can put them into the chat box and I'll monitor there. We'll give Michael the floor for the next 30 to 40 minutes, and then after that, we'll spend some time with Q&A.
Great. Thank you so much for that, Seb. And it's a delight to sort of be here again for the third time with Future VC, but I've actually done this presentation with another group outside of VC. Just a quick check, actually. Can everyone see the slides that I've just put up? Just sharing my screen now.
It's come up for me. If someone can kindly let us know in the chat box as well. Yeah.
Awesome. Thank you all. Brilliant. So greetings. Thank you all for joining today. We were just talking about the heat wave earlier on in the UK. So for those of you in the UK, I hope you're enjoying the heat, which is probably the last bit of sun that we'll have until we go back to clouds and rain in October. But in either case, I hope the rest of you are comfortable wherever you are. And in this presentation, Seb, I'm actually going to do things slightly differently. So I'll speak for about 10 minutes, and then we'll take a brief Q&A and break. Just to break things up a little bit. And then after that, I'll continue for another 10 to 15 minutes before we close with a more extended discussion and Q&A.
Fabulous, sounds great.
Right, so a bit of background. My name is Michael Tefula. I was born in Uganda. I moved to the UK back in 1999, hence the weird or somewhat strange accent. You'll notice there's a few words that might sound rather strange. That's because I grew up in Uganda, moved to Birmingham, lived in Oxford for a bit, and then worked in London for the last 4 years or so. As you can tell from the slide there, I love my food. But thankfully, this presentation will not be about food. It'll be about venture capital. So in all seriousness, my professional background started in corporate finance and accounting, where I got my initial training. A few years later, I went off to intern for a VC fund in Kenya before returning to the UK, where I ended up doing an MBA at the University of Oxford. After the MBA, I got into venture capital full-time, where I spent about 4 years investing in startups, all the way from pre-seed through to Series B investments. So while I was doing VC, I worked on over 20 different investments. I led a few deals, got promoted to principal. But then last year, I decided to join a startup. So today I work as a head of finance at a fintech company called Circa 5000. It's an impact investment platform. I'm also a part-time venture partner at Ada Ventures, which is a $50 million seed fund that invests in underserved founders and markets. In my spare time, I read and write a lot. I've just completed my 4th book, which is called Is Going to University Worth It? Which is a very pertinent question at the moment because of the ballooning student debt that we have in the UK and the challenges in the employment market. So those are books you can find on Amazon if you search for it, if you're interested. But I will move on from my background. Happy to take questions at the end in terms of my career journey, but we're not going to spend a lot of time on that. So the objective of the session today, the idea is to try and help you all understand at a fundamental level what venture capital really is. And to achieve that, it's worth going through the history of VC. It's also worth thinking about where the industry is today. And at the end of the presentation, we'll also think about some of the ways in which venture capital might change in the future. Hopefully, by sort of covering these 3 areas, I hope that by the end of the presentation, you'll have clarity on the definition of venture capital. You'll understand the basic organizational structure of venture capital. And finally, you'll get some ideas on the purpose of venture capital, as well as ideas about where future opportunities for innovation in VC might be. Right, so let's get to the good stuff. What is venture capital, right? Very straightforward question. You've got venture capital, the industry, but of course, that is also synonymous with venture capital, the noun, or the consumable itself, which is, in simple terms, the wealth or capital or risk finance that buys equity in high risk ventures with the aim of generating huge returns. Now, that's a mouthful, but to be clear, venture capital isn't bank debt. You know, that usually goes to less risky ventures or businesses, which have some assets or some trading history that you can rely on. And it isn't the capital that you find with friends and family or angel investors, since that type of capital is invested at an even earlier stage that institutional funds are not willing to participate in. We can also think about venture capitalism, which is the verb or the activity. And that is the systematic or professional allocation of surplus wealth that ends up going to high-risk ventures that promise outsized returns. So that's venture capitalism, the verb or the activity. Finally, we have the venture capitalist, right? So the individual who goes out and systematically identifies high-risk, high-return ventures. In this picture here, we have Luciana and Sonali. They both made the Forbes Midas VC list this year. So Luciana works at Sequoia in London, and she previously invested in UiPath, Deliveroo, Hopin. These are all multi-billion-dollar businesses, by the way. So she's an incredible, incredible investor. You've also got Sonali, who's a partner at Accel. She invested in Spotify, Go Cardless, and a number of other unicorns. Returning to our definitions, though, all the terms I've shared with you can, of course, be abbreviated to VC. So to kind of throw a spanner in the works and to really enjoy the quirks of the English language, we sometimes use VC in reference to the industry. Other times we are referring to the actual surplus wealth that ends up going to high risk, high return ventures. And often when we say VC, we are referring to the individual venture capitalists themselves. So these are things you're already familiar with, of course, but it's worth highlighting the distinctions because I will use the term VC interchangeably throughout the session. Hopefully, it will be relatively clear what definition I'm using, given the context of the discussion. But if anyone gets confused or lost, please shout, and I will be able to clarify. So where and when did this idea of venture capital first take root? Well, if we look at the core elements of VC, so this idea of taking a portion of surplus wealth and then investing that wealth in high risk ventures, which promise huge returns, we can kind of see that this is a practice that goes back for many thousands of years, and it isn't really as new as we think. For example, over 5,000 years ago in Mesopotamia, this is a region in modern day Iraq. It's where writing was invented. It's where the ideas of contracts and accounting statements were first conceived. And it's where entrepreneurship really started to flourish. In this region, you had public institutions like temples and palaces, which held huge reserves of surplus wealth. And often these institutions would basically act as venture capitalists when they would go on to fund merchants who would venture out of the region to export produce from Mesopotamia to other regions so that they could actually return with precious metals, for example. And upon their successful return, hopefully they came back alive, right? Because a lot of these expeditions were very dangerous. They would then share the rewards of their trade with the investors, right? The temples and palaces. We can also go to a more relatively recent time, right? So about 500 years ago, the Queen and King of Spain, so Queen Isabella and King Ferdinand of Spain, they funded this ambitious entrepreneur called Christopher Columbus, who set out on a voyage with about 90 men to discover new trade routes to Asia. Now, of course, in true startup style, he didn't really discover the trade routes that he set out to discover, but instead he had to pivot and he ended up discovering the Bahamas. This discovery helped kickstart the golden age of exploration around the world, and that in turn ended up generating a lot of wealth for the Kingdom of Spain. But again, I mean, that's 500 years ago and very much removed from the practices of venture capital as we know them today. To trace the more recognizable elements of the VC profession, we have to turn back to about 200 years ago in the mid to late 1800s. This is where we see a boom and eventual bust of the whale hunting industry. Now, quick background on this profession. In the 1800s, whales were hunted for their fat and flesh, from which oils could be extracted. This was before the petroleum boom. So following the Industrial Revolution, the demand for oil, which could be used in all sorts of machinery, was partially met, unfortunately, by extracting it from whales. However, whale hunting expeditions were really risky. So most ships that went out to get whales did not come back at all. Or if the crew made it back alive, they would do so at a loss, right? So they would go and try and catch something, but they'd come back without bringing anything significant back. So if you wanted to make money in the whale hunting profession, you had to make sure that you had a reasonable portfolio of ventures that you were backing. This is very similar to venture capital, right? So most startups today fail, but the few that make it do end up generating substantial returns. Now, why am I talking about the whale hunting industry? Well, the whale hunting industry is quite interesting because this is where we really start to see the evolution of how institutions and individuals who have surplus wealth go about efficiently pursuing and generating outsized financial returns. The whale hunting industry illustrates this in a number of different ways. First, if you had loads of money in the 1800s and you wanted to get in on the whale hunting action, the worst thing you could do was to try and invest directly in the voyages yourself. You know, these are very high risk ventures. You need to have a portfolio of voyages that you've backed so that you can spread your risk. And you need to make sure that you're dealing with captains and crewmen that you can actually trust. Now, all that needs a lot of expertise, needs a lot of time, it needs a lot of networks. And as a rich individual, these are things that you probably don't have. So out of this need emerged the idea of whaling agents. These were very well networked individuals who knew lots about the industry. They knew which captains were good. They knew which ones were not that good. They knew when the best time to go out at sea would have been. And they had all sorts of knowledge that most wealthy individuals or institutions did not have. Now, the whaling agents were the ones who would take capital from the wealthy individuals, and they would then invest that cash across a number of different expeditions. The chart over here actually illustrates what the arrangement looks like. And you probably want to keep this in mind because we'll come back to this shortly. The second point to highlight here is that the whaling industry figured out that the best way to actually incentivize the whaling agents is by making sure that you have interests completely aligned and reflective of the type of risk that these agents were taking. So if you paid the agents just a fixed salary, they would have no skin in the game and they wouldn't be that motivated in terms of generating the highest possible returns. On the other hand, if you paid the agents a nice salary, they would get paid regardless of whether they were successful or not in their ventures. So to align interests, what happened here was that the industry decided to have a fixed fee as well as a share of profits from these expeditions. Now, as you might already glean, this is where the idea of carried interest comes from. You will hear this word quite a few times actually during the Future VC program, and some of you might be already familiar with it, but the origins of the word go back to the days when captains and crew people would get a percentage share of all the goods that were carried back on the ships that they commanded, hence the word carried interest. It's a very powerful incentive mechanism that's still used to this day in venture capital. So in VC, general partners in a fund will get typically 2%, a 2% management fee. That's a percentage of the funds raised. And they will also get 20% of the profits that a fund makes. And people typically refer to this as the 2 for 20 incentive structure. This is very similar to what the whaling agents had in the 1800s, right? So they would get a fixed fee of around 2% of the total expenses for a voyage. And they would also get 15% of the profits from the goods that they brought back upon their successful return. And these concepts have stuck around for a very long time, right? So for the last 200 years, this incentive structure is still used. And actually, if you look at venture capital today, it's very similar to what the whaling agents had. So you can see from that structure there that it's very similar to what we had before with the whaling agents. Just to explain this chart in a little bit more detail. So in venture capital today, you've got the capital providers at the very top there. These are typically institutions which have a lot of wealth. So pension funds, university endowments, family offices, organizations that are managing billions and billions of dollars and pounds of wealth. You then have these general partners sitting in the middle at VC funds, also known as GPs. And then finally, at the bottom of the chart, you have the operators themselves. So these are the entrepreneurs who raise capital from the GPs and they go out and try to build successful businesses. In effect, what the whaling agents did well back in the 1800s and what VCs do well today really is to match entrepreneurs who have good ideas but no money with investors who have money but no ideas. And this organizational structure works really well because of how the incentives aligned. But there's certainly room for improvement, right? So I'll leave it to you as you go through the program to think about ways in which this organizational structure and some of the incentive mechanisms can be improved upon in the future. So I'm going to pause for maybe 2 or 3 minutes here because I think there's quite a lot to digest there, and just check in and see if there's any questions on what I've covered so far. So, feel free to add the questions to the chat box if there's any questions so far, and I'll give it a minute or so. If there isn't, I'll crack on. But let's see if anyone has any questions on the story so far on the history of VC.
Michael, are the questions visible to you as well?
Sorry, I was just looking at the chat box, so I didn't see any of the questions. I can see them now. There's a Q&A section.
Okay, great. Yeah.
Yes. So I'll try and get through a few of these before we crack on. So let's have a look and see. You discussed the 2 for 20 rule. Can you expand on it a bit more? Certainly, yes. So the 2 for 20 structure means that if I raise a $100 million VC fund, I will charge the LPs 2% of that $100 million every year. So if it's a $100 million fund, I will charge $2 million annually for the life of the fund. So effectively, I get paid $2 million a year for 10 years if the life of the fund is 10 years. So even though the fund size is 100 million, it will end up being 80 million because I'm taking off 20 million in management fees. Now, the 20% of the profit share is effectively what happens if I generate returns for my LPs, right? So if I turn the $100 million into 300 million, there's 200 million profit. I would take 20% of that as my reward for doing the work that I've done. Right, so there's another question here that I shall ask. There's a few here on my background, so I might leave these until the end. Okay, so Harriet is asking, so the 2 for 20 rule is similar to hedge fund fees structure. Yeah, so the 2 for 20 structure is also used in other asset classes, so private equity, hedge funds, but I think hedge funds actually charge a bit more. I've seen data that shows hedge funds can charge as much as 30 or 40% for some of the highest performing ones. So it depends on how good you are as an investor. You can then dictate what portion of profits you can take from your LPs. Okay, so I'm gonna answer one more before we continue, and then I'll answer the questions on my background towards the end. So there's a question here on, okay, so I'm gonna try and catch both of these. There's a question here, how often do GPs reinvest carried interest? It depends on the fund. I mean, GPs typically will maybe forego the management fee and they'll have that reinvested, but it really depends on the fund. What I've shared here is sort of the vanilla structure. And depending on how successful you are as a fund, or if you are an emerging fund, you might have to tweak the terms to be able to raise the capital from LPs. So I'll take that one as done. I'm going to answer one more question before we crack on. Okay, so some technical questions here I'm going to leave out for now, but we'll try and catch them at the end. I think this one's quite important for everyone on the call. So which team members of a VC firm receive a cut of the 2 and 20? So most analysts at VC funds do not get carry. I mean, so let's just explain the 2% management fee is what pays for the salaries, right? So if I raise a $100 million fund and I've got a 2% management fee, every year I will have $2 million that I can use to pay for my office, to pay my staff, to pay for lawyers and a bunch of other things, right? So if you join a firm as an associate or as an analyst, you will be paid from the management fee and you'll get a salary. Now, in terms of carry, the 20% profit share, typically that goes to the GPs, the partners, but some funds do pay principals a portion of carry. It depends on the fund that you're in, but typically associates don't get carry. I think if you get carry as an associate, you're doing really well. Right, so I will click that as done. Okay, there's just one more question I'm going to answer before we move on, because this is actually related to the whaling industry. So Angie is asking that in the history, what was the split between LP and investors? For example, I assume that the whale agents did not have 2% to live, maybe less, maybe more. I'm not sure what you're asking there, but let me try and answer it. So whaling agents actually would get 1.5% as their management fee, which was based on the total expenses of fitting out a ship. So if it was going to cost, I don't know, $100 to fit out a ship, the whaling agents would get 2% of that. So $2 back in the day, it must have been a lot of money, I guess, as their management fee. And that would help them sort of pay for their upfront costs. Right, so I think we'll move on and we'll have an opportunity to answer some of these other questions. There's some really good questions here on incentives. I think incentives are really important in your VC career, and we'll come back to them later on in the presentation. Right, I hope you're all sticking with me because there's quite a bit of nerdy history here, but I find it extremely fascinating, and I hope you do too. Okay, so back to the slides. Now, we've looked at the roots of VC-like behavior 5,000 years ago in Mesopotamia, where temples and palaces would basically finance adventurous merchants in the Bronze Age. We've looked at the example of the Queen and King of Spain who funded Christopher Columbus when he went out to discover new trade routes. And actually, his discovery helped unlock the golden age of exploration. We've also looked at the whaling profession, right, 200 years ago, and this profession flourished off the back of the industrial age, and it really set the scene for the organizational structure of VC and how you can go about pursuing outsized returns in a very systematic and efficient fashion. But as far back as the 19th century, the term venture capital didn't really exist. In fact, the term did not emerge until 1938, about 80 years ago, right? That was the first time the term was used in the way that we understand it today. So this is the guy who came up with the term venture capital. His name is Lamont DuPont II. I hope I'm pronouncing the name right. He was the president of the DuPont Corporation, which today is a multi-billion-dollar chemicals business. In 1938, Lamont DuPont campaigned and testified quite passionately to the US Senate that in order for the US to solve the unemployment challenges that came out of the Great Depression, the country actually needed a new type of financing and a new type of capital that would be supported by the government and other sources, which would then be specifically invested in small, innovative firms. Those firms would go on to commercialize new technology, they would create new jobs, and ultimately they would help reignite the US economy. Now, at the time, it was actually ideologically popular to support small businesses because of what happened with large corporations on Wall Street and the great crash of 1929. And of course, also in an economic downturn, wealthy individuals and institutions are far less likely to invest in risky ventures. Meanwhile, banks are certainly not going to be investing in any startups. Certainly companies that don't have any trading history or assets are not going to be able to receive bank loans. As such, engineering talent from places like MIT, as well as business officials, government officials, they all recognized that there was a major funding gap here. And people like Lamont DuPont went on to campaign for a new type of risk finance, which he called venture capital, and which would be an asset class that would be supported by the government through tax breaks and other incentives that would really encourage more wealthy people to actually part with some of the cash that they were hoarding so that it could actually go into young, thriving technology companies. With this bit of history, you can already see that the VC industry started to really take shape in the 80s, sorry, in the 1938s and the 40s thereafter. And the purpose was actually more than just making a few individuals wealthy, right? So the purpose of really promoting this new asset class was inherently linked to the greater good of the wider US economy. It was about funding innovation in small companies, right, that would grow, generate jobs, and reboot the US economy after the 1929 crash. And ultimately, the purpose of this asset class was to make sure that the whole of America would flourish. This is something we don't really talk enough about in VC. So few people ask what the purpose of the industry is. And for most people, it's just about the money, which is fair enough. But for few people, the motivations actually go beyond that. And certainly you can guess which camp is more likely to persevere through the ups and downs of the industry. So while the debate for encouraging venture capital started in the late 1930s, it took about 10 years before we started to see venture capital firms being established to specifically fund early stage tech startups. The first of its kind was the American Research and Development Corporation, better known as ARD, which was founded in 1946. This was an entity that raised money from insurance firms, university endowments, and the public market. So it was a publicly listed vehicle, much like Draper Spree in the UK. And ARD basically deployed capital into startups, many of which were university spin-outs. Now, the idea of investing in young technology companies back in the late 40s was really radical and quite scary, because it was yet to be proven whether you could systematically generate outsized returns by backing really high-risk, unproven technology businesses. ARD was the first VC fund to demonstrate that you could actually do this systematically. You could generate substantial returns by backing innovative companies. Their breakout success was an investment in a company called Digital Equipment Corporation, which designed and manufactured low price but high spec computers. ARD actually invested $70,000 for 78% of the company, right? So by today's standards, that's a ridiculous amount of equity to take in a company. But back then, there was no one else around who would actually be willing to fund a high risk technology company. So ARD invested $70,000 for almost 80% of the business. Thankfully for ARD, 15 years later, that investment turned into a stake that was worth $355 million. That's a 5,000x return. It's what we call in VC a fund returner. And you need one of these in VC as a fund manager if you're likely to meet your LP targets. Now, even though ARD managed to do really well with this investment in DSC and a bunch of other investments, actually, the fund actually ended up doing better than the stock market in general. And this performance was largely driven by the investment that they'd made. Despite that success, they ended up losing a bunch of their investment talent. And the reason for losing their investment managers was that as a publicly listed entity, there were certain regulations that prevented ARD from properly incentivizing their investment managers. So, for example, the managers could not partake in the equity upside of ARD, the fund, or the portfolio companies. So a bunch of investment managers left because all they were getting was a salary. Meanwhile, you've got a company that they've invested in here that's made a 5,000x return, and you're still getting paid the same salary. So a bunch of managers decided to leave and set up their own funds. In fact, one of the managers that left was a guy called William Elfers, who went on to set up a fund called Greylock and Company. Today, that fund is known as Greylock Partners. And he decided to actually set up that fund as a limited partnership rather than as a public entity, which was restricted by all sorts of regulations at the time. So now you're probably wondering, what exactly is a limited partnership? Well, in VC, a limited partnership is basically a private agreement that you have with your limited partners, your LPs, who provide capital that then you as a GP, a general partner in the fund, go on to invest in startups. However, limited partners are not involved and can't be involved in how the capital is deployed. In turn, the limited partners benefit from limited liability, hence the term limited partners. This means that if the partnership goes under, no one can really go after the limited partners, much like the protection you get from having a limited company. This structure also has a finite life. So the LPs that provide capital to GPs usually mandate that investments have to be made within 3 to 5 years, and the capital has to be returned, certainly, hopefully with a profit, within 7 to 10 years. So most VC funds that are established with a limited partnership agreement will have a very finite life, typically 7 to 10 years. Why do VCs prefer this structure? Well, the main advantage really is tax, right? So if you get a salary that's paid from management fees, that salary is taxed at the income tax rate, which in the UK, I think, is about 20%. But if you earn more than £150,000 in the UK, you will be taxed at 45%. On the other hand, if you get carried interest from a partnership agreement, you will be taxed at a much lower rate. So in the UK, for example, capital gains that you get from carried interest are taxed at 28% in the UK, which is substantially lower than paying 45% on your income tax. So over the years, VCs have sort of gravitated towards the structure, mostly because it's simply more profitable, but also as a private entity, you won't be scrutinized as much on things like performance data and other areas of regulation. Now, you might already see some disadvantages with this structure, which I'm not going to go into in detail, but I'm happy to talk about it a bit later on. But one of the key disadvantages I've already mentioned is that this fund structure has a finite life, so it isn't as evergreen as a publicly listed vehicle. Now, if you have a 10-year fund life, it means you have to deploy your capital within 3 to 5 years and then harvest your investments in the following 5 years and then return your capital to your LPs within 10 years. It means that there are certain investments that you can't make. For example, most VC funds aren't really set up to invest in basic science and invention. That stuff takes decades or longer to materialize. So you won't find many funds that are investing in biomedical companies or space exploration companies, which might take over 10 years to get anything to market. Most VC fund structures just don't allow that because of that 10-year shelf life. But despite that weakness, the limited partnership structure has actually proved popular, and lots of funds use it, and it maintains its popularity today. You do have some exceptions, as I mentioned. Draper Esprit in the UK is a publicly listed vehicle that invests in tech startups, and maybe we'll start to see a few more of those. But for now, the preferred structure is the limited partnership structure. It's got clear tax advantages, and as a private agreement, you can keep a lot of your data private without having to face all scrutiny to the public eye. So the VC industry has grown exponentially since the 1960s, right? So back in the 60s, you had maybe 10 notable VC funds in the US. By the year 2000, you had 800 VC firms in the US again. And last year in 2020, you had over 3,000 venture funds in the US, which collectively had more than $500 billion of assets under management. So the industry has grown substantially. I think it's a fantastic place to be developing your career, but it's not certainly without its challenges. So again, we've covered quite a bit here, but I've only got a few more slides to go, and we'll be able to dig into perhaps a Q&A that can last a lot longer. But the key idea to take away from all this history really is that venture capital has a certain essence to it. And that essence really is this, right? So the idea of venture capital is that you take surplus wealth from people who might not have anything better to do with that money, frankly, and you invest a portion of that surplus capital in innovation that promises significant economic returns. And hopefully alongside that, you might also have social returns. We first saw an example of this essence 5,000 years ago when the surplus wealth from temples and palaces in Mesopotamia was actually invested in merchants who were going outside of the region to export produce and bring back precious metals and goods that Mesopotamia did not have. We saw a version of VC in the financing that helped kickstart the golden age of exploration when the Queen and King of Spain funded Christopher Columbus 500 years ago. And we finally saw a evolved version of VC as the risk finance that goes into young technology companies and helps them thrive and grow. And we can see that that process was very much an American concept that came out of the back of the Great Depression. And with government support, with entrepreneurial support, with academic support, that industry turned into an industry now that has over $500 billion of assets under management in the US alone. So that's the history, but what is the state of play in VC today, and where might it be going into the future? Now, I'll just cover a few points in this next session before we get into Q&A, and we can actually have a more of a discussion, I think, which I think tends to be a lot more interesting. VC today is an enormous industry, right? So just last year, over $300 billion VC dollars was invested in startups across the whole world, right? So it's not just the US industry now, it's a global industry. In fact, now we have quite a lot of capital going into Africa as well. But of that 300 billion, about half, 164 billion, is in the US, which, I mean, to me, it looks like a huge number, right? In the sense that the last time we had that much capital going into startups was in 1999, before the 2000 dot-com crash. So in some ways, to me, 100 billion seems like a bubble, but there's certainly a lot more opportunities in the world today than there was in the 90s. So there's an argument to be made that we're just getting started in VC, and actually there's a lot more opportunities that should be receiving this capital. Another observation actually about venture capital today is that venture capital has a disproportionate impact on the markets overall. So I've got all these logos here because all these tech giants were VC backed. In fact, although 0.2% of companies get VC funding, more than half of IPOs are actually VC backed companies. So even though you don't need VC money to IPO, getting VC funded is in some ways validation of potential. And it's certainly linked to a much higher likelihood of becoming a huge, successful company. So the VC industry is massive, still growing, and it's very impactful on the overall global economy. Another observation in the last few decades is that financial returns in VC continue to follow a skewed profile, which is to say most startups and most VC funds actually underperform, but the few that do well do so immensely. And around half of the very best funds have proven some persistence or certainly repeatability in how they can generate outsized returns. In VC, you'll often hear that the VC business is a power law business. It isn't a normal distribution business. And what that means basically is that in this chart here, most of the returns skew to a small subset of investors. So that's the green portion of the chart over here, while the majority of funds actually underperform. And that's the yellow portion of the chart there. I've actually got a blog post about this, which explains why startups and the VC industry is subject to this power law return effect. That's linked to in the slides here. So if you get a copy of the slides, you'll be able to read the blog post on what actually drives power laws. Because I've always thought, why is this pattern in VC? What drives this pattern? And I've never found an answer. But if you read the blog post, you'll see the answers that I came across. Right, a little bit more data on the returns. I mean, this might not be good news for some of you, but it is the state of play at the moment, and it's been the state of play since VC emerged as an industry. So in terms of data, the key chart to focus on in this slide is the bottom chart to the right. And that chart shows something called the public market equivalent ratio, or a PME ratio for VC funds. And it splits that PME ratio across lots of different buckets. Now, the way the ratio works is that if you have a ratio of more than 1, it means that the fund has outperformed the returns you would get if you invested your money in the public market. So if I took all my cash and invested it in the S&P 500, for example, would I be better off putting that cash into a VC fund, or would I be better off putting that cash into S&P 500? If the PME ratio is more than 1, it means that the VC funds did better. If it's less than 1, it means that the VC funds did worse. So to put that number into context, if you have a PME ratio of 1.1 as a VC fund, it means that you did 10% better than the overall stock market. Now, if you have a PME of 0.5, it means that you've done substantially worse than the stock market. And actually, relatively speaking, you've lost your LPs a heap of money. Now, that chart at the bottom right there shows that only really 25% of funds, so the top quartile, actually generate returns with a PME ratio in the range of about 2.1. So that's doing substantially better than the public stock market. A further 25% of funds barely match what you would get in the market, and bearing in mind, all these numbers are net of fees. So if you remember when I was talking about the fact that if I raise a $100 million fund as a VC partner, I will take 2% as a management fee for 10 years. So that's 20 million taken out. So you're left with 80. And then I'll take 20% share in the profits. So all the measures I'm showing here are net of fees, right? Returning to the charts, you can see there that the other half of VC funds basically lose money, right? They've got PME ratios of less than 1. And that is the stark reality of the venture industry. Most funds underperform and don't achieve their targets, but there's a small portion, typically about 25%, that will consistently do better than what you would do in the stock market, right? So these funds are funds like funds you already know, right? Sequoia, Andreessen Horowitz, Accel, the big names that everyone knows. These are funds that are typically in that top quartile bracket. I've got a bit more data on this chart that I can talk through later on. But the focus really here would have been on that bottom PME ratio chart. A final observation about the VC industry is that, you know, it is still a relatively homogenous industry in terms of talent. And certainly it's very homogenous relative to the overall labor market. You've all seen the stats from Diversity VC, so I'm not going to go through them again here. But on the plus side, diversity is starting to improve in the sector, right? So thanks to programs like Future VC, we're starting to see more diverse talent actually enter into the industry. And this picture here is a picture we took back in 2019. These are the good old pre-corona corona days. So what does the industry have in store for the future? Well, if we look at the history of venture capital, we've seen that the best returns are made in areas that are yet to be explored. This will continue to be the case because if an investment area is obviously good, everyone piles into the area, valuations go up, returns go down. So as you think about your career, look for ways of positioning yourself in new areas that are underfunded, but areas which might have the potential for very, very high returns. Secondly, the history of VC shows that even though VC backs innovative companies, it hasn't really innovated as much on itself and on how it's actually structured as an industry. The reason for this might be that the existing models work really well, but another reason might simply be a lack of imagination. So I see a future in VC where the new generation of investors clearly have a fantastic opportunity to redefine the playbook, much like Y Combinator did with their accelerator model, or funds like A16Z, which introduced this platform model of having a fund that actually supports startups across several business functions. And of course, we have all sorts of interesting things happening in DeFi, right? So with crypto and decentralized finance, lots of really exciting things happening there that could potentially change the structure of how innovative small technology businesses are funded. Finally, the history of VC has shown that the original concept of venture capital was actually linked to the well-being of the wider US economy in that instance and its people. So given the lack of diversity in the industry, given the COVID crisis, given the climate catastrophe that awaits us if we don't change the economy significantly, I also see a future where venture capital might actually reconsider some of its original aims and shift more towards backing innovation that will, yes, generate significant financial returns, but also innovation that's intrinsically linked to improving society overall and increasing wealth for everyone, not just a few GPs that are very well paid. And that is it from me, actually. So, I mean, quite a lot there. I hope it wasn't too much to digest, but I guess we can now jump into the more exciting, certainly the bit of the presentation that I find really exciting, which is going through the Q&A. So Seb, if it's okay, I will hop onto the Q&A section now.
Yeah, absolutely. And we've built up quite a few questions there, so happy to kind of, maybe we can go from the top. I know you've done a couple of these already. Maybe we can kick off with a couple that are related to your background, in fact. So one from Rituja. How do you balance working for a startup and also working as VC? What are the dynamics of that? Oh, Mike, you're on mute.
Oh, sorry about that. Great question. I can't believe I'm still doing this after a year and a half of being on Zoom. But no, I mean, I spend about 80, 90% of my time working at Circa 5000, which is the startup that I work at. And the other portion is basically advisory stuff. So it's not intense. So I try and spend evenings and weekends still looking at startups, still looking at the venture capital industry and how it's evolving. And then I spend the majority of my time at the startup as head of finance. It's a tricky balance, but I enjoy the work. So as challenging as it might be, I find it very energizing to be able to spend the majority of my time in a startup, but then also move to the other side of the table and see how the venture capital world is evolving.
Great. We've got another one here about kind of how you transition from being a fresh MBA to Downing Ventures, and the question is, were there any business school resources that you found particularly useful in your journey?
Yeah, that's a question that comes up a lot, actually, in terms of if you do an MBA and you want to transition into venture. I would really encourage internships. So, if you can get an internship somewhere, it can help a lot. Before I did my MBA, I did an internship in Kenya for 4 months. I worked for a fund called Savannah Fund. It didn't pay that much, but it was a fantastic experience, such that by the time I started the MBA program, I already had some VC experience, because a lot of funds have this thing where they'll say, oh, we're not going to hire you because you have no investment experience. Well, it's like, how am I supposed to get investment experience if I haven't had the opportunity to work in a fund, right? So it's a tricky chicken and egg problem, but I would encourage you to try and find opportunities to do an internship. I did one before my MBA. I then joined the Oxford Seed Fund, which is a seed fund at the University of Oxford that's run by MBA students. It's a very competitive process to be able to get onto their program. But again, if you have some investing experience, it can help to make you more competitive. And then during my MBA, I then interned with Downing Ventures while I was doing my MBA. So again, that sort of helped me get my foot in the industry. Now, if you're not able to get an internship, I would almost try and do a kind of a virtual internship of sorts. So think about ways you can maybe build a virtual portfolio of investments you would have made if you were working at a VC fund. Make it public, put it on a blog post, set up a spreadsheet that tracks the performance of those companies, publish your investment theses, get out there and show how you think as an investor. You're not going to get everything right, and your thinking is probably going to be very crude, but get it out there, get feedback on it. And that usually just shows a bit more initiative than someone who might say, oh, I want to work in VC because it's really interesting. So, go out there and show some initiative if you wish to get a head start on the industry.
Well, Michael, perhaps one question for me. And I remember attending an event at London Business School. Lars, who's one of the partners at Balderton, he was giving the keynote speech. And he almost led his speech by saying to this entire room of MBA grads, don't apply for a job in VC, go and get some work experience in a startup in the ecosystem. Would love to hear your perspective on that kind of approach.
That's a great question. And I've been trying to write a blog post about this for 4 years. And the reason why I haven't published anything or even actually come to a conclusion is that you will get mixed answers, right? So before I joined the startup, I spoke to VCs who worked in the industry and then transitioned into startups. And I also spoke to people who worked in startups and transitioned into VC. And I also spent a lot of time speaking to people who were basically career VCs, right? They were VCs since they got out of university. And there's no one way of doing things. I think you have to look at your situation. You have to look at the opportunities that you have in front of you and try and play the game that works for you. So it's perfectly possible to be a career VC. Someone like Fred Wilson from Union Square Ventures, he's a career VC. He came out of university, I think did an internship somewhere, and he's been a venture capitalist since he was in his 20s. He's never worked in a startup, right? But then you also look at other people who have significant operational experience. For example, a lot of partners at Andreessen Horowitz worked in startups and they have substantial operational experience, but that fund is set up to actually be a fund that helps founders in a very operational manner. So I guess what I'm trying to say is think about the opportunities in front of you. So I had an opportunity to join venture out of business school. and I jumped at it because I thought, when is this ever going to come around? Equally, there was an opportunity to join a startup which was very aligned with the things I really cared about. You know, I really care about finance. I'm very interested in technology. I'm very conscious that we need to do something about climate change. And I felt that joining a startup at the intersection of those three things was an area where I could potentially contribute significantly. But of course, I'm still passionate about venture. I'm still here talking about venture capital. So I don't know. I think you should try and find the opportunities that are best aligned to you, whether that means you joining a startup right away because you can't find opportunities in venture, or whether that means joining a venture opportunity because the opportunity is there for you to take.
Brilliant. Diana's put a question in here. What do you find is the most challenging aspect of working in VC?
So it's different for everyone. For me, so I think some people might say the challenge in VC is like having to learn a lot. If there's any software engineers on the call, I'm not a software engineer, but I've done some coding in the past. Software engineers might be able to relate to it, because in software engineering, there's new frameworks coming out all the time. There's a heap, you have to keep learning. You have to keep learning because like things are moving so quickly. It's the same in VC. You always have to be learning. There's a lot of things to pick up on. There's new trends. People now are talking about the metaverse, which for me was a completely foreign word up until a few weeks ago. So one of the objective challenges in VC is having to rapidly learn about new areas. But for me, I enjoyed that because I love learning. As you can tell from the history of venture capital, I just love reading and I love learning about lots of different things. So for me, the challenge in VC came down to two things. The first thing was turning down amazing companies, right? So I mentioned earlier in the presentation that only 0.2% of new companies formed in the US get venture capital funding. So as an investor, you will look at loads and loads of companies and you will have to say no to a lot of amazing entrepreneurs. And if you have any empathy on what it takes to build a company, you might struggle with that. Eventually you get used to it, but it did take me a bit of adjusting to think, okay, well, at the end of the day, this is how the industry works. You will meet a lot of companies, you will meet a lot of amazing companies, and you will have to say no to them. Another quick challenge before we move on to the next question, because I'm probably belaboring the point, is that, as you saw from the presentation, if you set up a VC fund, you're committing to 10 years, right? So the companies you invest in, you will not see outcomes potentially for 5, 7, 10, maybe even 15 years. The last year we've had has been really good, right? So the markets are doing really well. There's loads of IPOs. You know, there's companies that are IPOing in 2 years or 1 year or 18 months because we have SPACs, for example, now. So we're at a very unique time, but historically speaking, it takes 5, 7, 10, in some cases, 15 years before you can see an outcome. So you need to be really, really patient in venture capital. Now, the flip side is, if you work in a startup, obviously things take a very long time to get to scale, but you can see the impact of your work a lot more rapidly. So that's the contrast from venture capital and startups.
Brilliant. We've got a couple of minutes to go. I think we can squeeze in maybe 2 more. Emma has asked, why do LPs still invest in underperforming funds?
Good question. So most LPs want to invest in the best funds, right? But there's always an opportunity to find a new emerging manager, right? So LPs don't set out to invest in funds that underperform, but they need to, at some point, allocate a portion of their, because they have billions and billions of dollars and pounds under management. They need to be able to allocate a portion of that in a high-risk asset class that can generate significant returns. But sometimes they don't get access to the very best GPs. So if I'm a pension fund and I'm trying to get access to, I don't know, Harry Stebbings, or I'm trying to get access to Accel, I'm trying to get access to Atomical, I'm trying to get access to Balderton, it's going to be very hard for me to get into those funds, because those funds already have other LPs that are committed. Sometimes they're oversubscribed. So what I will do as an LP is I will try and find emerging fund managers, right? So 15, 20 years ago, I would have been looking for new funds, right? So there would have been LPs who invested in A16Z, Andreessen Horowitz, as an emerging fund. they had no idea whether A16Z was going to be a top quartile fund, but they thought, hey, let's put a portion of our capital in this new emerging manager because someday they might turn into a top quartile fund. So yeah, I mean, they're not set up to invest in underperforming funds, but if you can't get access to the very best VCs, then you will try and invest in emerging fund managers. Some of them will go on to do really well. A few others will actually, in fact, most others will end up underperforming.
Fantastic. We have a bunch of other questions here, Michael. What I've done is I've made a note of the questions, and perhaps I can share some of them with you afterwards, and then we can kind of share the answers back with the wider group.
Yeah, happy to do so. Happy to do so.
Excellent. That was amazing. Thank you so much again for attending the session. I always learn more every time I watch it, so I really appreciate the effort, Michael. For everyone who's attending the session today, do reach out to Michael. He's on LinkedIn. He's got a blog post, which is fantastic. Do follow it, do read, and do reach out.
Great. Thank you so much, Seb. Really enjoyed this, and I look forward to hearing from some of the people on the call. Thank you so much.
Thank you so much again. Take care.